Okay, we're going to be talking about the statement of cash flows, and well, in particular, I'll be explaining a little bit the indirect method. The statement of cash flows is one of the four major statements in accounting, as you recall from the beginning when I started the course. The four major statements are the income statement and the balance sheet. That's two. The statement of retained earnings, and the fourth is the statement of cash flows. Okay, so the statement of cash flows is important because under GAAP, net income is determined using accrual accounting. So what does that mean? Well, it means that revenues aren't necessarily recognized when cash is received. And receiving cash and paying cash is very important, right? Some say it's more important than the actual recognition of revenue. What good is revenue if you haven't received cash? So many people, many analysts, and many investors like to look at the statement of cash flows as a complementary statement to the statement of income to try to understand, well, this is the income that the company reported, but let's see if how closely the cash flows track this income, right? If you have a company that has been reporting net income in the millions and millions of dollars, and then you look at their cash flow statements and they have negative cash flows, negative operating cash flows, we could understand having negative overall cash flows if they're investing in the company and they're growing, because they're going to be buying a lot of fixed assets and equipment, right? But if they have negative operating cash flows, this line over here, and they have lots of net income, then as an analyst or as an investor, you might say there could be a problem here, right? They're reporting a lot of net income, but I don't see it coming through as cash in their operating activities. So what's going on with this company? And so you could analyze them, right? On the other hand, you could have a company that is reporting net income, and when you look at their cash flows track very closely with their net income. So you feel a lot more confident about that net income number, which is an accrual number. But if you see that the cash flow tracks very closely with the net income number, well, you that builds your confidence that the accounting is being done properly, and that there's no that the numbers aren't being managed in a favorable way by the company. Okay, so it's a very important statement, and it's very complementary in particular to the income statement. Okay, there's two methods that are used: the direct method and the indirect method. I'm going to show you the indirect method for this course, which is a little easier to prepare because it simply takes net income and it starts to adjust it for differences between cash and accrual, and then we come up with what is a net cash flow from operating activities, which is simply net income adjusted for changes in the balance sheet that you can adjust over here, or the income statement. There's another method called the direct method. That method is actually easier to understand, because in that method a company would directly state something like cash received from customers or cash paid out to suppliers. That's why they call it direct, because it states what the use for that cash or what the source for that cash was in a very direct manner. However, this method takes a lot more work to prepare, so it's a lot costlier. And so companies tend to use the indirect method a lot more, because the indirect method is more mechanical, as you will see in preparing. And so you can prepare the statement of cash flows using the indirect method sometimes by linking accounts and so forth. I mean, you can almost determine what net cash flow from operating activities would be. For example, here we have depreciation. So if I just do a simple link of this 7,000 with this 7,000, so we can see the change in depreciation, I would have that line already adjusted, and so it's a lot more automatic and a lot easier to prepare. And that's the one that I'm going to teach you today. Okay, so here's a sample from the book, from the PowerPoint slides, as you can see, let's start with the different sections. Okay, the first section that you're going to find in a statement of cash flow is called the cash flows from operating activities. Okay, these sections, by the way, are the same whether you do it in the direct method or the indirect method, and they are also organized in the same manner. The cash flow from operating activities is the one that's going to be different in the direct and indirect method. The other two sections are pretty much the same for both methods, right? And if you look down here, cash received from the sale of land, this is pretty much direct, right? So even in the indirect method down here, you're going to get very good direct information. It's only on top that we sort of have just a reconciliation, and this information is okay, but it's not as good as the direct method, which is a lot more precise for what we're trying to do. As a matter of fact, let me show you. I think I have something here. Let me scroll down. Okay, so that would be the direct method. Cash received from customers. This is the operating activity section. Cash payments for merchandise, cash payments for operating expense, cash payments for interest, cash payments for income taxes, and net cash flow from operating activities. As you can see, it's very direct, very easy to understand, and you know exactly what the sources of cash were and what the uses of cash were in operating activities, as opposed to the indirect method, which simply a reconciliation. You see, increase in accounts receivable, decrease in inventories. It's a reconciliation, but does that tell me how much cash I received from customers or how much cash I pay to suppliers? This one will force you to do a little more analysis if you want to know that type of stuff, right? But it's more common for companies to use the indirect method because it's a lot easier to prepare. As I say, you can simply mechanically link it to changes in the balance sheet and income statement, and you could come up with this data a lot easier. So companies use the indirect method a lot more frequently. Okay, so where was I? I was explaining the different sections, right? So we start off with the cash flow from operating activities, and these are all the activities that will affect a company's net income, right? It involves current assets and current liabilities mostly, and changes in current assets and changes in current liabilities, okay? So it's going to involve mostly, cash obviously is involved because it's a statement of cash flow, but it's going to involve mostly these here, right? And accounts payable, and probably this one here, and as you can see, income taxes payable here, right? So what we do in an indirect statement is we go from net income and we start adjusting it, the difference between accrual and cash-based accounting, and we start making the adjustments. So we're trying to get to net cash flow from operating activities by taking net income and adjusting it for differences where we may have recognized a revenue but the cash inflow didn't come in, or we may have recognized an expense and the cash inflow didn't come out. So those are timing differences between recognition and actual cash flows, and that's what these adjustments here represent. So we're adjusting from net income all the timing differences between recognition and cash flows, whether it's inflow and outflow, and then at the end we come up with a number called that represents the actual cash inflow or outflow from operating activities, but by making all these adjustments, and we'll speak a little bit about how these adjustments are done in the last half of this video. Okay, then you have cash flows from investing activities. What are these? Well, these are the investments that the company makes in their fixed assets for the most part in the company, right? So they're going to involve mostly these here, right? Land, building, equipment, if you purchase an equipment, I don't have everything that goes in each of these here. So it's up to you. You need to go to the book, or you need to go to the PowerPoint slides, and you need to familiarize yourself with what goes in each category, right? So for example, here I may be missing interest income, right? Interest income is a part of the operating side of the section of a statement of cash flow, right? Down here, a purchase of equipment will come down here, right? Anything that you're doing to invest in the company, and it usually does, I don't think it involves an expense recognition up front. You expense it later on with time, right? So when you buy land, you don't expense it, right? You're simply purchasing the land, and you and you're capitalizing the land, and then later on you'll slowly depreciate it, right? And when you depreciate it, then that depreciation becomes part of the operating section. So when you buy or you sell land, when you buy or you sell a building, when you buy or you sell equipment, when you buy or you sell long-term investments, right? Not cash equivalents, not short-term cash equivalents, but long-term investments, or cash equivalent, by the way, there's no distinction between cash and cash equivalent here when we increase cash, right? So if this company were to have two lines here, which most of the time you're not going to be shown two different lines, but if we had a line that said cash and a line that said cash equivalent, we would add them together because they're the same here for the statement of cash flow purposes, okay? So investments here, not including cash equivalents, would go here in the cash flow from investing section, okay? And I can't think of much more. When you do a loan to a company, not when you receive a loan. Receive a loan, you go here. That's part of financing when you give a loan. So if I'm a company and I extend a loan to another company, that would be a notes receivable. That would go down here, right? Because it's an investing activity. I'm going to be receiving. When I say I'm talking about from the company that's preparing the statement of cash flows. Okay, I'm going to be receiving interest. So it's I'm investing my money in a sense, right? Okay. So let me see. Let me try to make sure that I got that right. When I extend a loan to a company. When I extend a loan to a company, yes, that goes into the investing section. When I receive a loan, then it goes into the financing section, right? So a bond is a loan, whether it's to another company or whether you sell it to the general public. It's a loan that you receive as a company, right? So it makes sense. This is called financing activities. This is related to the funds that come in to finance your operations. And as you already know, the two main sources of funds are equity and credit, right? So common stock, the sale of common stock, and or the sale of bonds to bring in loans, right? And so when those are also paid off, you also include it in the financing section. So as you can see here, cash paid to retire bonds is also included there. You also put dividends here in the financing activities section. Ironically, one of the biggest differences is that while dividends are put down here in financing activity, that's related to common stock, right? To paying the owners of common stock. We put interest income or interest expense up here, which is related to bonds. So the interest expense component does go up in this section here, because remember, when we recognize interest expense, it affects net income, so it's going to be up here, okay, not down here. But the dividends paid would go down here. Dividends received, let's say you had some investments in another company's stock and that company paid you dividends. Well, that would be part of your net income adjustment, okay? So go through the book and familiarize yourself with what transactions go where, okay? Because this is not inclusive of all of them, obviously. If I were to include all of them, the statement of cash flow would be way too long. This is just the one that's presented in our PowerPoint slides and probably in the chapter as well. Okay, so we start with net income. We adjust net income for all the differences in timing of cash flow. We have net cash flow from operating activities. That's the first major section. The second major section is cash flow from investing activities. Those are mostly fixed assets that we buy and sell as a company. And we show the net cash inflow or cash outflow from investing activities. The third section is cash flow from financing activities. How do we fund our company? Mostly common stock and bonds, right? Remember to include dividends paid here. And so that goes down in the financing activities, and it tells you the net amount you received and you lost. At the end, you're going to have, when you sum these three up, 1, 2, and 3, you're going to have what your change in cash was, increase or decrease in cash, right? I should probably do something like this. Increase, and then go like this, and oops. Let's do this, and decrease in cash, right? So if it's positive, we know we had an increase in cash, and if it's negative, we know we had a decrease. So it says we had an increase of cash of $71,500. If I come up here, and here's a comparative balance sheet, right? Year 2015, 2016. This is one of the major tools used to prepare your statement of cash flows. A lot of times, this is not sufficient. You're going to have to go to straight into the GL. But I'll show you later how I'm going to try to prepare this just using this. On some accounts, I won't be able to. I'll have to go straight to the GL because when when there's various transactions that go into separate sections in one line, then I need to get more specific and go into the GL. I can't just use a comparative balance sheet. But anyways, in this comparative balance sheet, which shows year 2015 versus 2016, it shows that cash increased by $71,500. So once I've prepared my statement of cash flows, I'm expecting for the difference to be, the increase or decrease to be $71,500 increase. And so it matches. So that's a good indication that the statement of cash flow was done correctly, right? And then you go cash at the beginning of year 26,000, which simply comes from over here. And cash at the end of year is going to be $97,500, and that's going to match. So of course, if you did this right and this matched with this, then you don't have to worry. This is just mechanical, and it's just going to happen normally. Okay, and that's pretty much the statement of cash flow. You're also required to disclose certain non-cash investing and financing activities. So these are, you don't use cash, but it's almost like if you use cash as a company. So for example, maybe you don't use cash, but you issue common stock to retire long-term debt. Well, you use common stock instead of cash. So you have to disclose it on the bottom or in some sort of disclosure note, right? I think I have more examples on this tab. Let's see. Yeah. So here are examples of non-cash investing and financing activities that we must show. We must show things like issuing common stock to retire long-term bonds, acquiring equipment in exchange for notes payable. That's something else that has to be shown as part of the non-cash investing and financing activities. Paying off bonds payable with common stock. Okay, issuing common stock to acquire assets. So all these type of activities, major activities that you may not use cash, but you're either issuing common stock or you're issuing some sort of notes payable or bonds to acquire some sort of assets. Eventually, this is going to lead into a cash outflow, right, as you pay off the loan. And issuing common stock, well, you don't pay off common stock, but you'll have to pay off dividends. So these major type of transactions, you'll have to disclose them after you've in the bottom section of the statement of cash flows. Okay, so familiarize yourself with all of these type of transactions that you must disclose. They're called non-cash investing and financing activities. Okay, so that's basically it. This is an indirect method statement of cash flows. As you can see, this is these are all the categories here. Remember, three major categories: cash flows from operating activities, investing activities, and financing activities. They show you the different changes in cash flows or cash used or cash received from those activities, and they must reconcile with the differences in your comparative balance sheet year over year. Okay, so let's do more specific examples. So if you see this has been pre-filled, and hopefully I'll be able to do this right on this side over here. Okay, so what I did is I simply took the same statement of cash flow that we saw over here here in this tab, and I just blanked it out over here so that we could go line by line and see how we can fill this statement of cash flow up. So we start off with net income, of course, and that's received from the income statement, right? That's all you have to do. You go to the income statement and you put your net income. Before you start inputting your changes in operating assets, you're gonna put changes in fixed assets or transactions related to fixed assets that affected your net income, right? Depreciation is one. I already mentioned that, right? I already mentioned that when you buy a fixed asset, it goes here, but as you depreciate it, the adjustment goes up here. So let's take a look at depreciation and try to understand it intuitively, right? What's depreciation? Well, depreciation is the recognition of expense for the use of an asset, right? So if I depreciate something $1,000, I'm expensing it. Now the question is, was there a cash outflow related to that expense? And the answer is no, right? At this point, you should know that. So my depreciation reduced my net income, but there was no cash outflow. So if my depreciation reduced my net income, but there was no cash outflow, I must add it back to this number if I'm going to get a cash flow from cash, right? Net cash flow. So I must add the depreciation back. So I'll add the depreciation back, and I'll put $7,000 because that reduced my net income, but there was no cash outflow related to it. Okay. Gain on the sale of land. I don't get that one from over here. I will have to go to the income statement to look for that. So gain on the sale of land is $12,000, right? A gain is a recognition of a positive recognition, a positive increase into net income. It's caused by the difference when you sell an asset above its book value. So apparently some asset, land, was sold, and land had a book value, let's say, of $100,000, and it was sold for $112,000. So the gain is $12,000, right? Well, the $112,000, let's say you received that in cash, is going to be entirely recognized down here, cash received from the sale of land. Okay, so you're gonna recognize the full cash that you received down here. So this $12,000 is simply an accounting transaction that does not affect cash flows here. It's just a gain. It increased your net income, but you did not receive a cash flow from this transaction. Although some may argue that you did, but still, we're going to put the full 112 in my example. It's not really 112, it's a different number. I don't remember, but we're going to put the full cash inflow here. Okay, so we'll adjust it out up here, that small portion. So gain on sale of land, that increased my net income, right? But did I receive cash inflow specifically for that gain? No. So I must adjust this out. And that'll be a negative. Now let's take a look at these categories. And keep in mind that for many of these, you cannot do it at, if you use one line for each of these, then you can probably do it straight from here. But for the most part, you're probably going to have to go into the GL. And, for the testing, don't worry. I'm not going to make you, we will provide the information specifically. So I'm not going to make you try to decipher, what different transactions came out of one line. I'll tell you all the different transactions pertaining to one line. For example, you're going to see an example in land here that you're going to see an example in land where, excuse me for a second, an example in land where we have various transactions affecting different lines in the statement of cash flow. So I can't just look at this line and use it in my statement of cash flow. I have to look for further details here. Okay? And those type of details will be given to you. You don't have to worry, okay? But in this case, for example, accounts receivable, I don't need specific details. This is just one line. So I could come over here and I could look at this and I could say, okay, my accounts receivable went up by $9,000. What does that mean? That means that I sold $9,000 worth of merchandise, more than a net more. So my income statement received $9,000 more in revenue, but did I receive the cash? No. If I would have received the cash, it wouldn't have gone into accounts receivable, right? So I must take this out from here, right? Equals minus 9. So let me try to give you an example of accounts receivable. See if this, I have here the example of land, which I'm going to show you later. But let me go with accounts receivable here without deleting this example. So accounts receivable, delete. Let's go ahead and delete all this stuff here. See if I could give you a good example of accounts receivable. And I don't think we need this. Okay, so accounts receivable. Let me put this up here just in case I need it later on. Another T account up here. One more line. Yeah, one more line. And let's bring this up here. Okay. So if you don't understand how changes, increase or decreases may affect your income statement, what I suggest is you come and you do a T account, okay? And you try to make your example as simple as possible. Okay, so this is my first year, year one. I start off. My beginning balance in accounts receivable is 0. I end up with, let's say, $10,000 in accounts receivable. Okay, so what would this be? What's the entry here? The entry is accounts receivable 10,000, right? And sales revenue, sales rev. And that's going to be 10,000, right? That's the GL entry. Okay, so sales revenue goes into the income statement. So you know that your net income went up by $10,000 and your AR went up by $10,000. Did you receive cash at any other point? No, at least not related to this transaction, right? There's no cash. So you know that an increase in accounts receivable will increase your net income, but will not give you a cash inflow. So you must subtract it, right? Let's say in year 2, the customer pays $2,000. Okay, so what's the transaction related to that? Well, the transaction related to that would be to you have reduced your AR in this case, right? And the customer paid, so you increase your cash, right? And this was a reduction of $2,000 from one year to the other. This year you ended with $10,000. This year you ended with $8,000. So you had a reduction of $2,000, right? And that's the transaction. So what does this tell you? Well, it tells you that when there's a reduction in AR, you've received cash, but you haven't but you don't recognize revenue because you already recognized it the year prior. So a reduction in AR you'll have to add it to your reconciliation over here on this site, right? I hope that, so that's what you're going to have to do, and you're going to have to understand that. And if it's difficult to understand, you're going to have to do a lot of exercises and problems from the book until it becomes second nature, right? So my AR increased by $9,000. That means that I sold a net of $9,000 more in cash than in merchandise than I received cash, right? Because the customer still owes it to me. So my net income went up by $9,000 more than the cash that I received from sales. So I'm going to have to adjust that out because I have not received $9,000 in cash yet, right? Decrease in inventories. Okay. When you buy inventories, you have a cash outflow, right? But when you sell the inventory goes down and you recognize a cost of goods sold, right? So what are you doing? You're recognizing expenses, right? But did the cash outflow occur at that period when you recognize expenses? No. The cash outflow occurred when you purchased the inventory, right? So if you have a decrease in inventory, that's telling me that I recognize cost of goods sold of $8,000 here that did not affect my net income, right? My net income was affected by $8,000, but there was not a cash outflow, right? So within this net income statement, I've decreased net income by $8,000 because I sold a net of $8,000 more in inventory. So I had cost of goods sold of $8,000, which decreased this, but there was no cash outflow. So I must increase it to my net income. Okay. For those of you who are new in accounting, this may sound a bit confusing, but you're going to have to then go to the T accounts and do all these type of transactions, just like I did with the AR, to try to understand what happened there. So if we look at this account, we will say inventories. When we purchase inventories, if I purchase inventory the first year, you see I should have done this. So when I purchase inventory the first year, I have a cash outflow. Let's use the exact same numbers. I have a cash outflow of $10,000, right? That's when I purchase it. That's an increase in inventory. And it's 10,000, right? This is year one. This is the type of thing that you're going to have to learn to do to understand how these increases and decreases affect your reconciliation to net income, okay? So, and then inventory goes down, and then in year two you sell inventory, so you're going to recognize a cost of goods sold, right? And inventory goes down. So if inventory increases, right, that means that you had a cash outflow for inventory that did not affect your net income, right? Nothing here affects your income statement. So you're going to have a cash outflow. So if that is not reflected in net income. So if inventory increases, then you know that you have a cash outflow that did not affect your net income, which means you're going to have to add it to your net income, right? If net inventory decreases, so now net inventory is going to decrease by 2,000, right? Year one ending balance was 10,000. Year two ending balance was 8,000. It decreased by $2,000. So what does that do? Oh, well, this is the transaction. This is the entry that recognizes that. Did you affect your net income? Yes, you affected your net income by $2,000, right? And you reflect it by reducing your inventory. But does this affect cash flow? No. So you know that you've recognized $2,000 in expenses, but there was really no cash outflow related to it. No cash flow at all related to it, whether it's inflow or outflow, right? So you must adjust that out. So you're going to add it to your net income because there was no cash outflow. So a decrease in inventory is added to your net income, okay? Decrease in accounts payable. Okay, decrease in accounts payable. So we already, let me highlight these. So we already took care of this line. We took care of this line, right? And we took care this. This is our first one. Let's see what else we took care of. We took care of this line, and we took care of this line here. Okay, so let's try to make this whole thing yellow and see how it translates over here into the statement of cash flows. Okay, so what's my next one? My next one is accounts payable. There's a decrease in accounts payable. Let's take a look at the T accounts again to see how that affects me. And again, I could use the exact same numbers. There's no need to change numbers. Year one, I sell inventory, right? So accounts payable is a liability. I mean, accounts payable is purchases. I buy merchandise, right? So in my year one cash, well, if I bought it on credit, then it's not cash. So I bought it on credit, right? So let's say I bought supplies, and I bought it on credit, AP, right? So my AP increased by $10,000 there. Okay, so now that's in year one. In year two, I paid off $2,000, right? Accounts payable. So I paid down $2,000 of my accounts payable, right? So let me see how this is done. Accounts payable. I do have something wrong with this example here. So I have $10,000 balance here, right? So let's say next year I pay down $2,000 of this balance, right? So I'm gonna go here, cash, to pay down $2,000, and my AP. Oh, I see what's wrong here. So this is a liability, so I have to change sides. I gotta change sides here. Okay, now we have it right. AP 10,000. Okay. And then AP. Okay. So now I have it right. Okay, so I had $10,000 in AP. In year 2, I paid off $2,000. So there was a decrease in AP by $8,000. I paid out the cash, but did I recognize the expense over here at any point as it relates to AP? You know, I may recognize it somewhere else, but as it relates to AP, no, right? So there was no recognition of there was no cash outflow. Or actually, in year 2 there was a cash outflow, right? There was a cash outflow of $2,000, but there was no recognition of expense, right? You're simply paying an accounts payable from a prior year, and that's probably when you recognize the expense, right? In this case, supplies expense, and you have accounts payable. So here you recognize the expense. Here you recognize the expense. And here you're just simply paying out part of that expense. So as you can see, a decrease in accounts payable would be would decrease your cash, but it does not affect your net income. So if you decreased your cash without affecting your net income, then it must be subtracted out, right? So there was a decrease in accounts payable, which did not affect your net income. That means that you paid out cash of $3,200, but it's not recognized up here, so now we need to recognize it. Notice how now I put it directly because this is a liability, okay? And if a decrease in the liability is put negative, then an increase in the liability must go positive, right? So it's the same example, accrued expenses payable, right? So again, let's go to the example. When you accrue an expense, accrued expense, you recognize the expense, right? So let's say I accrue my rent expense, but I haven't paid it yet. So this is rents payable. So you're going to recognize your rent expense there, right? Expense is an asset, and you're going to do accrued expense. In this situation, it increased, right? So we added another 2,000 here. Okay, well that's it. What does this tell me? That I did another accrual, at least another net accrual here. So you did another 2,000 here, right? Of whatever it was some sort of expense, but you know that you increased it by 2,000. So rent expense and accrued expense. You're accruing expenses here, but is there a cash outflow? No, that's what the accrual means. It means that you're going to recognize expenses before the cash outflow occurs. That's why you're accruing. Now you accrued another 2,000 in expense. Again, no cash outflow. So an increase in accrued expenses means that you've lowered your net income, but there's no cash outflow, right? So you want to add it to your net income. Okay? So this is the last chapter of the course, and it may be the most difficult, but if you practice this, you'll eventually get it. So this is you need to add it to your net income, 2,200. And I hope after I do this, I have it all right, because I certainly spent a lot of time doing this. I hope I get it right. Okay. income taxes payable. These are all very similar. Payable, payable, payable. We know that a decrease in payable was put as a decrease. So I'm not even going to bother to analyze this one. Income taxes payable is the same thing. It's a payable. So it's going to be treated exactly the same way. Decrease was put as a decrease here. This is a decrease. I'm going to put it as a decrease there. And I'm not even going to bother analyzing it. Okay, so 100,500 is my net cash flow from operating activities. Let's see if I got that right. Let's cross our fingers. Oh, whew, I got it right. Yeah, after 45 minutes, I don't want to start this video all over again. Okay, so now let's do the second section of let's do cash flow from investing activities. And as you can see, we've already taken care of a good portion of the balance sheet. The balance sheet goes up to down here, and so pretty much once we have all this in yellow, we're pretty much done. Cash received, this is one of those that I was talking about that we must go into the GL directly. This is not going to help me. Why? Well, if you look at here, you see cash received from the sale of land, and you see cash paid for the purchase of land. So I have two transactions here, and they're commingled into one line. So that's not going to help me. So you can't always do it directly from the comparative statement. You must go straight into the GL to be able to distinguish this. So let's say I go straight into the GL, and I believe that I did it here. Yeah, I had done this beforehand because I knew that I needed this information. Okay, so I go straight into the GL, and I find that I go cash paid for the purchase of land. So my cash account, my land account went up, and I find that that's the transaction that made it go up. Okay, in the test I will tell you, I'm not going to make you guess. I will say land was purchased for $15,000. So, but as an accountant, nobody's going to tell you. So in this case, this line here isn't going to help me at all. I need to break it out more. So I'll go into the GL, and I see the GL, and I say, oh, okay. I see that the GL says that I purchased land for, this is my starting balance, and I purchased land for $15,000. Okay, so cash paid for the purchase of land, $15,000. Wait a minute. So I put it, I'm supposed to put it negative, but it's going to be subtracted. In this section, we're going to put it positive here. Remember, it has the caption less, so it's going to be subtracted. Okay? Because it's a cash outflow, right? Cash paid for land. Cash outflow. So we got a portion of that, right? $15,000. So if part of this was a purchase of land, part of this asset, that means that had I not purchased the land, this ending balance would have been 80 minus 15 is 65, right? It would have been 65 had I not purchased the land, which would have made a difference of $60,000, right? It would have made a difference of $60,000, which, as you guess, would go here, right? That's the book value, that there was a reduction. But let's not forget, we have a gain on sale of land. So what does that tell me? Let's analyze this. Well, if the land that I sold had a net book value of $60,000 and I obtained a gain of sale on land of $12,000, that means that I must have sold the land for $72,000. And that's where I put the $72,000, a cash inflow of $72,000, okay? So even though we took out the gain of sale of land here because it affected net income and there was supposedly not a cash inflow, there really was a cash inflow, but we're going to put it all here. The whole $72,000, we're going to put it here. The reduction of $60,000 here pertaining to that, right? if you don't see it, let's just pretend this transaction didn't occur at all. This would have been 65,000, right? And our change would have been 60,000. So I would have known that I sold land for $60,000 and that I obtained land with a book value of $60,000, right? And that I obtained a gain of 12. So I must have sold it for $72,000, okay? So I know I sold it for $72,000. If I look at the T accounts, $60,000 was the sale of the land, a gain of sale of land of $12,000. This is the transaction, right? Cash 72, land, and gain on land. So the whole 72 will come over here on this section. And then the gain of here up top, I'm going to just adjust it from out of net income. Okay. I would reconcile the same if I would have put 60 here and not put this transaction over here, but that's how it's done. And then last but not least, cash paid for the purchase of building, at least in this section. So let's see, cash paid for the purchase of building. I come over here, I go building went up by $60,000, and then but you know, does this tell me the whole story? No, it doesn't tell me the whole story. Why? Well, I could have you know, issued common shares for this building. I could have taken out a mortgage for the building. I don't know that I paid it all cash. So I could either analyze all this here and look at this and say, well, did I issue bonds? Bonds went down by $50,000, so I probably didn't pay this with a bond. Did I issue common stock? Well, common stock went up by $88,000 and paid in capital went up by $40,000. So there's a possibility that I did issue these for this building. So I can't really tell you what if this was paid cash or not. I got to dig in deeper. So that's a situation in which you will go straight into the GL and you'll look at the building GL and then you'll see through your journal. It's not even the GL. You want to look at the journal, right? Because you want to look at the offsetting entry as an analyst. What's my offsetting entry when I bought this building? Well, my offsetting entry tells me that is cash. So there's my answer. I paid this with cash. I could also figure this out by analyzing these down here as well and eventually figure out that I paid for this cash, but that's not going to be, but why do that if you could go straight into the GL? And so for the most part in the test, I'll tell you building was purchased for cash. I'm not going to make you do this incredible analysis so that you can then figure out that it was paid for with cash. But if you had to do the analysis, then you would leave this one blank for now, and you'll look down here and you'll try to figure it out. Okay, so we look into the GL and we look for the transaction. We look into the journal entries and we find that building was paid for cash, right? So you paid out cash for building, so you put 60,000 here. We're going to put it positive, but remember it's subtracted out. So this whole 75,000 is subtracted out from here, and we have a net cash use of 3,000. Let's see if we got it right. $3,000. Yes. Okay. So now let's go down to these transactions here. Cash received from the sale of common stock, right? So we know that the sale of common stock, and even if we sold this common stock and then used the cash to buy the building in the previous example, you still have to report it like this, okay? Cash received from the sale of common stock. So when we sell common stock, we all we have to do is come up here and this will tell you the cash received, right? We sold 8,000 more par and we paid in capital increased by 40. So we must have received $48,000 total in cash received from common stock. Okay, so I forgot to yellow this out, and we're going to yellow this out. cash paid to retire bonds payable. Okay, again, how much did we pay for bonds payable? This is just one transaction. We saw that this went down by 50,000, so we must have paid 50,000, right? So I'm going to put 50,000 here, but I would warn you that if you were truly doing this at your job as an analyst, you're not going to do it like this. You want to go into the GL and make sure that this was just one transaction. You want to make sure that this 50,000 relates to one transaction to pay down your bonds payable. Okay, and you will look at the details more deeply and analyze them better than what I'm doing here. Okay, but these are simple examples, and they're simplified for you. So. And I put a note here because, okay, so if you see that note there, then you know all this pertains to this note, and so you know it all belongs in one line, right? And cash paid for dividends. So how are we going to figure out cash paid for dividends? This one is a little more complicated, right? So we know that retained net income rolls into retained earnings, right? So theoretically speaking, my retained earnings should have gone up by 108,000. It did not go up by 108,000. It went up by 80,000. What's the one thing that reduces retained earnings? Let's forget about repurchasing. Let's forget about stock dividends for now. Well, one thing is just normal dividend payments, right? That reduces retained earnings. I'm missing $28,000, so I must have made a declaration of $28,000 in dividends payable. Okay, so I made a declaration of $28,000 in dividends payable. So let's see what happened with my dividends payable account. My dividends payable, if I declared $28,000 in dividends payable, should have gone up by $28,000, right? Because that's based on this analysis down here. That's the amount of dividends payable that I declared. But it only went up by $4,000. So what does that tell you? That of the dividends that I declared, the $28,000, I paid off $24,000 already, or else this would have gone up by $28,000, and it did it. It only went up by $4,000, so I paid off $24,000 of it. It could have been from the prior year, it could have been from this year. It doesn't matter to me. The bottom line is that I paid off $24,000. So cash dividend paid off is $24,000. Okay. So does this match? Okay, so let's see if we did this right. So we pretty much took care of all of this. So you can see there's a lot of analysis to be done here. Don't be as scared. You should know the analysis, and you should know how to do all those analysis. That last one that I did is a little bit complicated, but hey, you have to know it by now. So do a lot of exercises. So we go up here and we analyze. Increase was supposed to be 71,500. Hey, I got 71,500. I got it right. And then obviously this is just a plug from here, and then this is my ending cash balance. So once these match, you know that you did it right. And so while we're almost reaching the 1 hour mark here, okay? So that's the main thing here, and I'm really glad I did this all right, because or else I would have had to start the video all over again. So your next step is to put down all the non-cash investing and financing activities down here. Here are some examples. Familiarize yourself with all types of examples that go down there. And that's it. This is a statement of cash flows using the indirect method. Learn how to analyze transactions. Learn how to analyze this in light of how it affects your accrued net income to come up with the cash adjusted net income, or cash adjusted flow from operating activities And that's learned through doing exercises, and a lot of exercises. I already show you a technique here of how you can, understand how these changes affect net income. When you do these exercises, always do them as simple as possible, because it doesn't matter how simple or how complicated the example that you use here is. It's the rule applies the same. So why don't you just use a very simple example? Like, this is my first year. So my beginning balance was 0, and it increased by 10,000. So what does an increase do to my net income, right? And that will be that will be your example, and whatever answer you come up with, it's going to be the same regardless of how complicated the transaction is for that particular type of line item. Okay, so this is it. I hope this was helpful, and like I said, just continue to study, read the books and the PowerPoints, because there's other topics, other areas that will be tested, but this takes care of the majority of it. Okay, thank you.